Jessica Alba asks you to do something, you're going to do it. It doesn't matter who you are. You could be the CFO of Chipotle, and you're like, what? I'm a board of directors of this company over here? Well, it's Jessica Alba. Like, I can't say no to that. Come on, man. There's power, okay? There's different types of power in this world, okay? That's all I'll say about that.
Oh, Jessica Alba. Oh, you're so hot. Oh, let me rub my nipples. Oh, Jessica. Welcome back to Strongman Personal Finance. We have a very special guest today. She better behave or there's going to be some trouble. Anyway, I got to do a reaction to a video where old Jeremy LaFave compared The Honest Company to Elf on a Shelf. Now, if you don't know what Elf is, it's this cosmetic brand with their own stores. And Jeremy first found out about them because apparently he's a huge fan of Jeffree Star, a massive and very interesting YouTuber. And I'll leave that at that. So Jeremy LaFave is very big into The Honest Company, mostly because of Jessica Alba. And he's known to buy small cap, unprofitable trash stocks, which is fine. Are you okay, baby? Okay, this might not work out here. Anyway, so Jeremy recently did a video where he compared The Honest Company to Elf on a Shelf. So what I'm going to do is I'm going to compare these two companies. Are they actually equivalent? Is Honest Company the next Elf stock, or is it something totally different? So first of all, I want to go ahead and look at the broad financials of these two companies. So here we have The Honest Company, okay? Basically, they make diapers and wipes. They have a cosmetics brand. And they make basically a bunch of home health care, clean stuff, stuff for the family, stuff for the wife, stuff for the baby. Now we could see right off the bat that Honest My Bonest is having a little bit of trouble with revenue growth. We could see their revenue from last year is only up about 2.33%. We go down and look and we see that they have a gross margin of roughly 30%. And that has actually dropped by 3 to 6% since their previous couple of quarters, which is not that good, okay? You don't want slowing revenues and declining gross margins. That's a bad thing. We can see their operating margin is negative, okay? We can see their profit margin is negative. And we can see their free cash flow margin is negative, and it's actually increasing. As a matter of fact, their most recent free cash flow margin could be because of low operating cash flow, or it could be because of capital expenditures, was negative 30%. So what I see in The Honest Company is a company that's struggling to grow revenues, struggling to grow dominance in a very competitive industry. There's 1,000 different diaper brands out there, and they don't make any money at all. I don't see any improvement in the fundamentals whatsoever. We go to the balance sheet. Let's compare their current ratio, total current assets of 194 to their total current liabilities of 61. They're not going to go bankrupt within a year, hopefully. Long-term assets, they have 54 million, and long-term liabilities, they have 31 million. Once again, not that bad. So overall, their balance sheet isn't the worst thing in the world. But you can see their balance sheet, their equity is being weighed down by continuing losses with the company. They keep losing money, and that's destroying stockholders' equity. We can see it goes down every single quarter because they're losing money. How does this company make money? Well, let's see where they get their cash from. Their operating cash flow, this is the cash from their fundamental business, is negative. They are losing money from operations. They are spending more money to buy inventory, pay employees, that kind of stuff, than they are making it. So they need cash. And eventually what happens is when you burn through all your cash, you have to raise money. You can do that through debt, or you can do that through issuing stock, which leads to dilution. So overall, The Honest Company had pretty bad free cash flow, and it was mostly because of negative operating cash flow. And if I remember correctly, I think they had a massive inventory purchase that was, way outside the bounds that they normally do. But at the end of the day, they're losing money, okay? Let's go compare that to Elf on a Shelf. So here's Elf stock. This is one of Jeremy's greatest successes because, like I said, I guess he's a huge fan of Jeffree Star. That's cool, man. So Elf is a totally different story, okay? We can see that Elf is actually accelerating revenues. Their revenues are blowing it out of the water. Look at this year-over-year growth, 26, 10, 13, 26, 33. Pretty good, right? Especially compared to Honest. Gross margin. Look at the gross margin. 63, 63, 65, 64, 67, 65. Operating margin, positive, 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 positive in the low teens. Pretty good. Profit margin, kind of all over the place, but they are profitable and they have been consistently profitable. And they have positive free cash flow. Do you see the difference between these two businesses just based on the fundamentals? Honest has crappy revenue and half the gross margin that Elf does. And Elf actually makes money both on the cash basis and on the accrual basis of accounting. But that's not all, ladies and gentlemen. So one of Jeremy's biggest bull theses about Elf on a Shelf, or excuse me, Honest, is that Honest is growing their makeup brand. Because according to him, it's probably true. Makeup has very high margins. That's why Elf has a 60% something gross margin. Makeup, girls like to pay money for makeup. And maybe I do too. And I know Jeremy does for a fact. But we could see, and this is the Honest Company's Q3 earnings, there's some interesting things going on with their skin and personal care. Now, in 2021, for the 3 months ended September 30th, 2021, they made $25 million of revenue from skin and personal care. That has declined year over year by 13%. That's right. The skin and personal care segment that he seems to be more focused on has declined revenue. Why did that revenue decline? Well, it seemed that there was some kind of makeup that was dropped. Revenue was negatively impacted by 25 percentage points due to a prior year skin and personal care rotational program with a key club retailer that did not repeat this year. Well, it seems like their brand may not be selling as well as you may think. So the one thing that would give Honest the highest margins is declining revenues. What is gaining revenues? Well, diapers and wipes. I can't imagine those are very profitable. Maybe they are. Maybe I'm crazy. And household and wellness had a very massive increase, but that's because they came up from almost nothing. Now you compare that to Elf, and I was just going through Elf's quarterly report, their most recent one. They're blowing it out of the water. Like, this company is just killing it because they are more focused on actual makeup products that have those high margins, whereas Honest has a much smaller percentage of their revenues that is on those high-end products. And on top of that, Elf is growing their revenues, and Honest is declining their revenues in that category. Very interesting, huh? Okay, so let's go ahead and read this. Are you alive? Are you okay? Yeah. We're almost done. So, this is their Q2 results. They had a net sales increase of 33%, 190 basis points increase in gross margin, and BS earnings up 47%. Okay. Look at the sales growth. I mean, they're just blowing it out of the water. Can't really hate on this company. Thanks, Jeffree Star. Now you keep going down, and you can see that their Elf Cosmetics is largely driving their growth. Consumption's up. Let's see. Oh, what's this? Top 5 mass cosmetic brands share basis points versus a year ago. So Elf is also gaining market share. Wow, look at that. Is Honest doing that? I mean, maybe, but not as fast as Elf is. I mean, look at this. They're absolutely killing it. We can see here, what is this right here? Number 1 teen favorite brand, Elf. Favorite shopping destination, Elf, number 9. We can see Ulta's on top. We got some big names up here, and Elf is sitting there at number 9. Do you see Honest? Well, Honest doesn't have a shopping location, but I mean, do you really think Honest would be on here? I don't think so. So overall, I don't see the comparison here, okay? I don't understand how you can compare a company that has declining revenues in a segment. Are you okay? We'll end soon. They have declining revenues in a segment that has the highest gross margins, while Elf is absolutely blowing it out of the water. I really think Jeremy likes this company. I'm not joking, because Jessica Alba is hot. All right, let's do some quick comments, and then I got to get this child out of here. Jessica Alba owns it. I think she's a 5% shareholder. VT versus Jerry Small Caps is hilarious. I'm crushing him on there. Let's see. He buys diapers from Honest. Very bullish from the stock. Yeah, I don't buy diapers from Honest. Listen here, strongman. Keep bullying LaFouf, and I'm going to debit the hell out of your PP&E reevaluation reserve and depreciate. Okay. All right, that's accounting humor right there. Okay, so honestly, at the end of the day, I don't see a. All right, I gotta go. I don't see a comparison between the two companies. You guys have a wonderful day. Cheers.